Hey, this is John. Today I want to educate you on why it is a problem when the government intervenes with the central bank and their independent operations. If you didn't know it, this was a problem already. So, I want to start by giving some background first, just to clarify the relationships that are going to be discussed, because this isn't exactly a simple issue. I mean, the solution is very simple. It's, leave the two independent and don't interfere with each other, though they do kind of have to cooperate, as I'll explain. But the relationships are, and how the central bank behaves in the market is somewhat complicated. So I do have criticisms of economics, by the way, as I've, addressed in other videos, though those criticisms are primarily pertaining to a lack of ethical concerns in economics. And for the sake of the economy, I think economics works more or less pretty well. Just sometimes you have to separate economics from people. Now, for the sake of this video, though, we're just going to be explaining the economic rationale and assuming that things like GDP improvements will also be conferred as benefits to the citizens of a nation, as has been kind of assumed in economics and generally throughout at least most of history. So, first, the central bank is a separate entity from the government, and this is required for the sake of foreign investment to be independent from the government. So, if they were dependent, foreign investors would view this as risky behavior and they wouldn't trust those institutions. They would pull their money out away from the country in question. So, why would they do that? So, they do have several other open market operations, but the most important of the operations of the central bank is the interest rate that it sets. And other banks will reference this interest rate, or from this interest rate develop their interest rates when they loan to you, for example, or entrepreneurs, whomever. Though that's the interest rate that those banks can borrow at. So they add, then obviously a certain amount on top of the central bank's interest rates, right? So right now in Canada, for example, the central bank's rate, I think it's 2.5%. 2.5%. So, you might get a loan at like 5% at the bank. And that, accounts for the risk that the bank takes giving you a loan. So it's important to understand the role these institutions play in the economy and that they are functionally different. The central bank functions primarily to regulate the economy and uses interest rates effectively as capital injections, and I'll explain that later. Whereas the other banks, such as your commercial banks, function to make a return on their investment. And that's different. These investments are typically loans, by the way. The bank is effectively giving out bonds, if you will, and you have to make interest and principal payments on them. So that's why I use the term investments. This has resulted in the central bank, these differences, having had very low interest rates and sometimes even negative interest rates. This is something that you won't see at your commercial bank, but you will see it at the central banks. So, for example, the central bank will do this during periods of quantitative easing. And what that does is then they pay other banks to take out loans from the central bank. And the reason for this is to inject capital into the economy. So how this works effectively is that when banks' rates are lower, loans are more affordable. So by the central bank lowering its interest rate, other banks can borrow at a lower rate and will give out loans at lower rates. What this does is, suppose that you are a startup entrepreneur or an existing entrepreneur. Well, now you can take out a loan at a lower rate, and so what this does, it makes capital cheaper. So that's the point of capital injections into the economy. it allows businesses to expand. And then, jobs will get created, blah, 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 presumably. Now, on the flip side, when interest rates increase, business investment slows. They can't take out as many loans. So expansion slows down. So one thing to consider, though, is that on the flip side, and this is part of the balancing act of the central bank, is that a loan creates money. The relationship is described by what's called the reserve ratio, or the money multiplier, which is determined by the reserve ratio. And the reserve ratio is set by the central bank, and this basically tells the commercial banks what percentage of their loans or their assets to be loaned / total deposits need to be held in a reserve. So, and we have some pictures, by the way, up here that are going to kind of show this relationship. But money itself is, as all assets, governed by supply and demand. So the point is that if the supply of money goes up as more loans are given out, provided that the demand stays the same, then the money loses its value. And this is basically what's the main driver of inflation, which isn't the only one, by the way, because inflation is just ultimately the increasing of prices, or that your money can buy less for the same amount. So the biggest culprit, though, is the increase in money supply from these central bank rates, right? Now, and also inflation is typically measured against domestic goods, not foreign goods, for obvious reasons, right? Okay. So certainly, and this might not be obvious actually, inflation itself isn't necessarily bad. And for example, we can see that, in periods of inflation, when the central bank lowers its interest rates, it's not just more money that gets created, it's more money that goes in circulation. And we have that economic expansion that I was talking about. So it does support the economic expansion the expansion of businesses, economically speaking. And to summarize, again, this relationship so far, central banks sets interest rates, lower interest rates support economic expansion, but result in inflation. So the issues with keeping the interest rate low forever obviously then stem from inflation primarily. And even to its own goals, it will become counterproductive if they just stay low forever. Because in addition to other things such as basic capacity limiting expansion, people will become unable to afford as many goods and simply can't buy more. Now, we say clearly why a central bank regulated by a government could be a problem. The open market operations of the central bank are considered reversible, typically, for example, as the loans can still be exchanged. However, if the central bank should be used to, say, consolidate the debt of the country and, print off a bunch of money to pay a government's deficit, the country's monetary base will be permanently increased. And this will devalue the currency, raising the nominal price, and the nominal price is the price that's unadjusted for inflation, by the way, of assets such as real estate. So, non-reversible. Now, we might say, well, suppose it's an emergency. And this can certainly be the case, but government debt is one of the most misunderstood topics in economics, and I'm going to explain that. First, we need to look at not just pure debt. We need to look at the debt in comparison to the GDP, because the GDP is going to tell us the ability of the country to pay off that debt. And by itself, the debt metric is meaningless, as it's high compared to what? And whether or not the debt, even like high debt, is a problem is unclear anyways. So the suggestion by the CFA Institute, for example, has been that a 4% surplus in the deficit, or a country with 104% of, say, its GDP in debt, is at an unsustainable level. But most developed economies have much higher amounts of debt relative to their GDP, such as the US. And they don't seem to experience any problems, way above 4%. Then there are also foreign and domestic debts that are owed. And this is another very important point, because in the figure of debt, the majority is typically domestic. And that means that the country owes that money to its own citizens. And economists typically view this as not a problem, because the citizens can't withdraw money from their own country, for example. Whereas foreign debts, which are in a much smaller amount, can be withdrawn, and those are typically where the problem lies. But it's in a much smaller amount, right? So this isn't really a problem, is what I'm trying to say. So, despite what you've heard about the national debt, it's hardly an issue. And it certainly isn't worth monetizing. So you should probably consider why politicians are always complaining about the debt, and maybe it's for, cutting public spending on goods that are good for you. So, removing money from public services and goods at your expense. And I don't think anyone should find any of that surprising. I did do a video on Project 2025, for example, their handbook. And some of the stuff in there is actually, it's being pretty nice in the video, but it was pretty embarrassing to read some of the stuff, especially given that a lot of these people are supposedly well-educated. And I guess that means that they were paid to lie. It's some of these excerpts, but some of the information in there is things like exports don't contribute to GDP, for example. Net GDP, they say. It doesn't matter, by the way, but because it's just wrong. And another thing that I found funny, ideally the US would control all of the world's resources, and then they argue from that stance, right, which is silly to think about. And even without going into what's technically stupid about some of these positions, such as those related to the two examples that I'll put on screen, exerting control on the central bank, which again just all these arguments are propped up by bad arguments, or they don't have arguments supporting them in the first place. Now, similarly, on another sort of funny note, very recently, Scott Bessent has come out stating that tariffs don't cause inflation, which I'm also going to address here. It's basically obviously true that if we include goods that are unaffected by tariffs in our aggregated statistics, that we will show a less significant effect. But they obviously increase prices for the affected goods. So I have a graph for steel prices up, for example. Then we have a graph for general prices on screen. So, and I did try to pick the simplest graphs, by the way, just because some of the other ones do require explanations of things like delayed effects and blah, blah, blah. Additionally, it's obviously not, as I mentioned, the only factor of inflation. So a lot of the arguments I have read online regarding this issue have effectively amounted to tariffs are not the sole cause of inflation. And that obviously doesn't express any view on the matter. I mentioned earlier in this video that interest rates and the giving out of loans is the main cause of inflation domestically. And this doesn't mean that they don't result in inflation. That referring to tariffs, of course. So tariffs in particular, though, are worse than, say, lowering interest rates because they're not accompanied by economic expansion, for the economy broadly speaking, at least. So they are a worse kind of inflation. Anyways, I'm sure that Mr. Besant is just putting on a little show because there's no way that he actually thinks this. And you will find a lot about tariffs in the Project 2025 handbook, where on one hand they present a combination of self-defeating and easily disproven arguments, and on the other, those arguments are accepted anyways. So some of these people did go to the Yale, of course, so maybe they know something that I don't. Yeah. Anyways, the theoretical backbone of the current administration for sure is it leaves something to be desired, I would say. And that's maybe the biggest point of this video and why everyone is concerned about the meddling with the central bank. So, I hope you found this video instructive and helpful. If you did, to understand what's actually going on, please like, share, and subscribe, and I'll see you in another video.